faithfully delivering value, interpreting global great books. Hi, everyone. This is Sally's Book Club. Today, we're exploring former Federal Reserve Chair Ben Bernanke's memoir, The Courage to Act, a memoir of a crisis and its aftermath. And finally, in this book, Bernanke recounts the 2007 subprime mortgage crisis and his decisive actions, offering insights into financial crises and global economic trends. This memoir provides an unparalleled perspective. Born in 1953, Bernanke studied at Harvard and MIT. After earning his PhD at MIT, he began his academic career. He spent 17 years at Princeton University. In 2002, President George W. Bush appointed him to the Federal Reserve Board. When Alan Greenspan retired in 2006, Bernanke became the new Fed chair. He held this position until February 2014, steering the U.S. Central Bank for 8 years. Bernanke took the Fed's helm just as the subprime crisis and European debt crisis erupted, triggering global financial turmoil. His aggressive market interventions earned him Time magazine's 2009 Person of the Year. While controversial, Bernanke's crisis management helped prevent another Great Depression. The U.S. economy avoided 1930s level collapse, making this memoir essential for understanding the crisis. The Fed's policies under Bernanke impacted global economics profoundly, particularly his quantitative easing policies, whose effects continue shaping world economies today. To understand modern economics, we must examine Bernanke's original strategies. This 560,000-word memoir will be explored in 3 key sections. First, Bernanke's economic philosophy and policy framework. Second, how his Fed confronted the financial crisis. Third, reflections from Bernanke and American society on the financial crisis. Let's begin with part 1, Bernanke's economic philosophy and policy framework. Among Federal Reserve chairs, Bernanke stands out as particularly unique. He was directly appointed by George W. Bush from being an economics department chair to Federal Reserve governor. After brief transitions through 2 positions, he succeeded Alan Greenspan as federal chair in early 2006. With virtually no political experience beforehand, this was a meteoric rise. Why would Bush promote someone from mid-level bureaucrat to national leadership? This relates to Bernanke's economic theories and policy orientations. Trained under new Keynesian pioneer Stanley Fischer, Bernanke focused his research on the 1930s Great Depression. Bernanke's grandmother survived that era, telling young Ben stories of shoemakers' children going barefoot. Why couldn't they buy shoes? Because you see, factories closed and fathers lost jobs. But why did shoe factories close? Because nobody had money for shoes. An inescapable loop. But why was there no money? That's the million-dollar question. In academia, Bernanke encountered works by Milton Friedman and Anna Schwartz. A Monetary History of the United States convinced Bernanke that deflation caused the Depression, resolving his doubts. And deflation, simply put, means money disappears from circulation. Insufficient currency prevents basic economic exchanges. Producers can't sell goods while potential buyers lack purchasing power. Building on Friedman, Bernanke fully coded depression mechanics. Bernanke argued that depressions are panic acceleration processes. It might start with temporary liquidity shortages. Objectively, short-term fluctuations become contagious fears, escalating into societal panic. Take a small bank experiencing loan fraud. Objectively, a minor loss, but nervous depositors might trigger bank runs. When other depositors hear people lining up to withdraw money, they join the queue too. A random incident escalates into bank runs, collapsing the small institution. Bernanke viewed financial systems as panic amplifiers during crises. Banking networks transmit panic between consumers, businesses, and financial entities, creating economic collapse. This became Bernanke's renowned financial accelerator theory. From this theory emerged his new policy framework. Inflation targeting maintains mild, predictable price growth. The Fed publicly commits to 2% annual inflation through monetary policies. This ensures liquidity, prevents deflation, and stimulates growth. When Bush took office post-dot-com crash, stagnant growth and high unemployment demanded new solutions. Economist Glenn Hubbard introduced Bernanke to Washington policymaking circles. Bernanke's inflation targeting impressed Bush during Oval Office meetings. Despite lacking political experience, Bernanke received immediate Fed promotion. As chair, Bernanke replaced Greenspan's ambiguity with transparent policy frameworks. History soon provided Bernanke's theories their ultimate test. When the 2007 subprime crisis hit, Bernanke acted decisively to prevent 1930s-style collapse. Let's summarize Bernanke's economic philosophy in 3 points. First, unregulated systems amplify random events into panic-spreading deflationary accelerators. Second, deflation was the Great Depression's root cause. Third, crisis demands aggressive intervention in financial institutions. Fourth, inflation targeting establishes growth-protecting expectations. Now let's explore part 2, how Bernanke's Fed tackled the financial crisis. The 2007 global financial storm unfolded in 3 distinct phases. Let's examine Bernanke's targeted responses during each stage. Phase 1. The subprime mortgage crisis. Subprime loans or mortgage products for low-credit, low-income borrowers. When applying for mortgages, borrowers must provide income documentation. Banks also check credit histories. Past defaults would disqualify applicants, true in both China and the US. So why did US lenders issue such risky loans? Didn't they fear defaults? This brings us to financial innovation gone wrong. To boost housing, entities like Fannie Mae packaged mortgages into tradable securities. Lenders offloaded risk by selling loans to investors. This created perverse incentives for reckless lending. Underwriting standards kept getting relaxed. Even unqualified applicants received mortgages. These risky loans became subprime when rated by agencies. Initially successful, homeowners got houses, lenders earned fees. Rating agencies profited, markets gained new investment products. The government saw booming real estate and job growth, a win-win. But human greed distorted this financial innovation. Lending standards collapsed completely. Predatory products emerged. Adjustable rate mortgages, ARMs, teaser rate loans. What's an adjustable rate mortgage? And what about teaser rate loans? They start with low introductory rates that balloon over time, increasing monthly payments. These predatory loans trapped unqualified buyers through deceptive affordability. Common sense asks, what if borrowers default? But lenders didn't care. They'd already sold the risk to investors. As subprime defaults surged over time, toxic assets spread through bundled securities mixing good or bad loans. When subprime bundles collapsed, they contaminated entire portfolios. This attracted short sellers betting against mortgage securities. Shorting means borrowing securities to sell high and repurchase low. Mass shorting accelerated price crashes, devastating institutional investors. The house of cards finally collapsed. On August 9, 2007, BNP Paribas froze 3 U.S. mortgage funds. Their funds became unsellable as defaults spread. Investor redemptions blew the crisis wide open, spreading from Europe to America. Major players like Rhinebridge Fund and Countrywide faced bankruptcy. Wave 1 of the crisis. Bernanke's tripartite response. First, acting as global lender of last resort to European central banks. Second, opening the Fed's discount window floodgates to domestic banks and financial institutions. The discount window serves as crucial monetary policy infrastructure. Pre-crisis, the Fed only offered overnight loans to banks. Bernanke extended terms to 90 days with rollover options. He established the primary dealer credit facility, expanding access to non-bank entities. Third, slashing rates as commodity prices showed decline. Within a year, federal funds rate plunged from 5.25% to 0. Despite these measures, panic persisted with mounting institutional losses. Phase 2, subprime crisis metastasized into full financial storm. December 20th, 2007, Bear Stearns revealed 1.9 billion subprime losses, becoming short seller targets. Interconnected derivatives contracts created systemic contagion across Wall Street.